Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook. Today's Wednesday, 23rd of January 2013. We are already in the middle of the week. The highlights for today go as follows. As said yesterday, released Japanese Bank of Japan's decision. Prime Minister sets inflation goal, and with the next on the list is a new Bank of Japan governor. As said, the Bank of Japan raised its view of the economy for the first time in 8 months, as private consumption held firm and the business sentiment improved, in the sign that Prime Minister Abe's policy of easy money and big spending has begun taking effect. Improvement in exports and recently compiled economic stimulus steps will likely put the economy back on the recovery path, but slowdown in overseas economies remains a risk factor. The government announced in its economic report. Said the Bank of Japan yesterday put this target of 2% inflation and started the open bond buying process that will take effect at the beginning of 2014. That basically disappointed a number of investors that expected basically the immediate action. From the other side, the U.S. debt limit vote is set for today. A measure to extend the U.S. debt limit for nearly 4 months is due to be voting is due to be today, and the White House said the President Obama would sign the bill if it cleared the Congress, easing uncertainty that could have threatened the U.S. economy. Recall that one of the rating agencies 2 weeks ago warned the United States that they might lose their AAA rating in case of not acting accordingly and promptly in order to vote for the new limits for the U.S. debt. Yesterday's comments of ECB President Mario Draghi, who said that Eurozone has passed the worst. He keeps his standing that the worst is behind us compared to the other hawks from European Central Bank that said, we mentioned it yesterday, I think, that said that still in 2013 we are going to see the bottom of the current crisis. According to Mario Draghi, the ECB Eurozone, can begin 2013 with more confidence than last year, but it is up to governments to carry the bloc forward with the reforms while the European Central Bank delivers stable prices. Draghi's pledge in July last year to do whatever it takes to preserve the euro and his following up plan for a new ECB bond purchase program helped bring the Eurozone back from the brink of a breakup. In a New Year's speech, the central bank chief highlighted the impact the bond plan, dubbed outright monetary transactions, has had on easing tensions, but put the onus on the governments to press ahead with the reforms to retain confidence in the bloc. The commitment shown by policymakers in the 17-country bloc last year to securing a stable euro meant that the darkest cloud over the euro area subsided in 2012, Mario Draghi said in his yesterday's speech. And just a brief look at yesterday's release of German investors' sentiment that showed the highest levels since May 2012, and the moral hit its at the highest levels in more than 2.5 years in January. That suggests the Eurozone crisis is no longer hurting Europe's largest economy as much as it was late last year. The ZOO think tank set its monthly poll of economic sentiment climbed for a second month to reach its highest level since May 2010, rising to 31.5 points from 6.9 points in December, and this was the biggest monthly rise in a year. From the markets, Japanese yen continues to gain strength against US dollar. Some of our initial targets have already been reached we're pointing towards 88 zone in yesterday's late yesterday's comments that has been tested 88.05 since so far. We might see some corrective action preceding fresh weakness of dollar against the Japanese yen, but overall picture now changed. The sentiment is more negative. We look for 87, I would say the support. This is the 87.78, pardon, the 16th of January low as a break point for a further reversal as the pair accelerated this reversal from a 90.23 peak of 2.5 years, accelerated after yesterday's Bank of Japan's decision. The euro dollar, it's still in a sideways mode as shown on the 4-hour chart. Still we are within the range, though the near-term structure is slightly aligned towards the downside with yesterday's hectic trading and bumpy raid on within 132.70 and 133.70 with spikes up and down, basically did not affecting more significantly the single currency as it came back to the original levels of yesterday's opening at 133.00, currently holding around this level with slight pressure seen still towards the downside as hourly structure is still negative, but while within the range of 132, I would say 80 and 55 as the lower border and 134 on the upside. There will be no clear direction. Break of either side is to define the fresh direction for the pair. Cable remains under heavy pressure with yesterday's rejection to regain initial 159.00 level and quick return back to 158 support, where the basing attempt is now evident but lacking strength and the momentum for any stronger action. Sees the later 158 support under increased pressure, and the break here would be a good signal that the further weakness is quite likely as the price broke below the 4-month range defined on the downside by 158 zone and on the upside at 163.80. Basically break below 158.26 range floor, and the 158 as psychological support would be a signal for some stronger action. Lower 157.50 and 157 seen on a break. From commodities, oil resumes its bull rally after a couple of days of congestion under previous high at 96.48. Fresh extension high reached 96.87, showing that bulls remain in control, and steep ascent from 85.20 higher low of 11th of December. Seems to be looking for extension initially towards Fibonacci barrier to 98.54 since the next, but more significant is psychological $100 per barrel barrier that comes in the near-term focus, and a number of analysts already speculating that it's a matter of time when the oil price will hit this level. From the other side, the yellow metal remains stable but still unable to clear psychological 1700 barrier, with the near-term range being established between 1684 and 1695. Holding above 1684 is still keeping the upside bias in play, but clearance of last week's spike high at 1697 and 1700 is required to confirm the bullish action and the open way towards initial barrier at 1706. While only break below 1684 would more significantly harm the near-term structure. And that's from the highlights for today. We're going to take a look at the today's calendar as show the Australian CPI fourth quarter dipped to 0.2% compared to 1.4% in the third quarter, giving a now signal for possible further easing of the monetary policy from Central Bank of Australia. Chinese leading index for December came at 0.4%, disappointing compared to 1.1% in November, while the batch of data coming from UK starting at 9:30 GMT, where we have the MBC minutes minutes of the latest meeting showing unchanged the configuration of the votes in their last meeting, with unemployment rate in November expected to stay unchanged at 7.8%, and the climate count change is going to show slight improvement. 0.8 thousand is seen forecasted for today compared to draw of 3,000 in the month of November. Another significant release is zoo economic expectations for Switzerland. Now due at 10 o'clock, again improvement is shown according to expectations, that is -5 compared to -15.5 in the month of December. If we follow the model of Germany and Eurozone yesterday, that showed a very significant improvement in the economic investors' morale, then we might see some better results also in Switzerland. House price index from US due at 1400, the GMT 0.7% forecast compared to 0.4%. And then more significant is the Bank of Canada rate decision that is due at 1500, the GMT 1% unchanged is today's consensus, followed by rate statement announcement from the Bank of Canada. At the same time is Eurozone consumer confidence for December, a slight improvement seen in the forecast of -25 compared to -27, but still showing that Eurozone is heavily affected by current crisis, and basically that would be these would be the most significant and releases for today, 23rd of January 2013, and we are going to move to our technical part, as most of you expect to see what we can expect in the coming hours in the markets regarding the major currencies and commodities. Hourly structure of euro-dollar is slightly aligned towards the downside, as I said at the beginning, as the pair still holds around the 133 zone, with indicators still pointing lower and seeing a slight pressure towards the downside as the price holds below all three 10, 20, 55 days moving averages on the hourly chart, seeing immediate focus in the near term at the downside supports at approximately 132.80. These are the lows. Yesterday spike at 132.66. Basically, this is the strong support zone, 132.80 to 132.55, which is low of 16th of January 2012, and the break below these levels as a recent range floor, reinforced also by 38.2% Fibonacci retracement of the uplift from 129.96 to 134.02 at 132.47 is seen as a trigger for a stronger easing. So far, the ascending 55 days exponential moving average of the 4-hour chart holds the downside despite some spikes through yesterday, and holding above this support would keep the neutral tone in play around the 133 that is now been cracked. That was initially good support for the single currency, and basically we can see that in past couple of sessions nothing much changed despite yesterday's a lot of noise seen in the movements following the releases of economic indicators in Japan and the post Bank of Japan release market action. But the pair came back to its rather neutral mode, and is still, I would say, more sideways as shown on the 4-hour chart. No clear direction for now. We're looking either break of 132.55, 132.50, I would say, for to direct it lower, or bounce higher that requires initial break of initial 133.70. Yesterday's spike high, and of course more significant and strong barrier at 134.00, break of which is to signal resumption of the larger uptrend established from 2012 low in mid-November of 126.60 that so far reached 134.00, with the break here to open next barrier, that is 135 zone psychological resistance, also marking a 76.4% Fibonacci expansion, and also this is the weekly 200 days moving average at 135.24. So we have quite a strong barrier. Of course, before this is at 134.85 February 2012 peaks. In case of a break, of course, in case of break above 134.00, conversely below 250, we will be looking for 132 as psychological support and 50% retracement, and then 131.50, 61.8% retracement in case of loss of 132.80, and then 132.50 strong supports for the euro dollar. British pound, as said at the beginning, is remains under pressure. Basically, yesterday's dip to 158.05 was followed by a corrective action that was mainly limited by descending 55 days exponential moving average. A spike higher reached 158.82, still unable to reach 159.00 as a psychological resistance, where is also 200 days moving average as shown on the daily chart, and this is acting as quite a strong barrier, and subsequent failure to break an upside rejection at 158.82 and subsequent return lower retested again recent lows 158.01 seen so far in the recently. Basing attempt is still evident here, as this so far proves to be good support, no clear break here, but all technicals are still pointing lower, and see more potential for possible break below 158.00. That will open way down towards 157.70, 157.50, and then 157.00 as a round figure and psychological support. Some corrective action might be seen on a bounce from 158, but anything below 159 is quite strong. An initial barrier would be just seen as a brief corrective action. To see more significant recovery, we need to see break above, I would say, minimum 159.50-60, where it's 38.2% retracement and a 55 days exponential moving average, while break below 160, previous strong support, and the psychological resistance, which is also close to half of the recent down leg from 161.77 to 158.01 would provide relief, and they would signal basically the base at 158.00 for some stronger recovery. For now, negative tone that dominates in the lower time frame studies still keeps the downside favored, and unless we see the break above, as we said, 159.50, 160.00, the more focus will remain towards the downside. Of course, most of investors are awaiting the release of the UK data that are due in approximately 1 hour. That will give some more clues of near-term movements for their currency against the US dollar. Dollar-yen remains in the downtrend of 90.23, with yesterday's acceleration seen on upon release of Bank of Japan's data, with nearly, I would say, 85% retraced, 85% being retraced of the initial 87.78 to 90.23 rally, with the negative outlook seen in both 1 and 4 hour chart studies, seeing potential for a further break, basically break below 87.78 and 87.62. That marks 76.4% retracement of the larger rally from 86.81 to 90.23. Is seen as a breakpoint for a stronger easing. That will confirm the top at 90.23 and allow for a stronger reversal of the larger uptrend of dollar-yen that started approximately in November 2012, when the pair gained from 17, approximately 79 level, I do apologize, to 90.23 so far. Descending daily studies, RSI already below the out of the overbought territory, and all other indicators pointing lower are supportive for the current movements, and see potential for further extension higher. From the other side, slightly overbought conditions on the hourly chart may see some corrective action higher, but 88.78, 89.00 now offer quite good resistance, and seen capping at this point. We have the 89 as a previous peak of yesterday's, basically yesterday's intraday high, reinforced by descending 55 days exponential moving average, and this level is seen as ideal reversal point for a lower top and fresh, higher low, lower top and the fresh extension lower. I do apologize for small confusion. Overall sentiment is still negative, and we still see favored, downside favored, as a clear break below 88.00 that has so far been reached but not cleared, and then 87.78 would be a signal for some stronger bearish action of the dollar yen following the action of yesterday's release of Bank of Japan's monetary policy. And finally, dollar Swiss from the currencies remains stable above 92.80 support. This is basically the floor of the recent congestion, and also the support is reinforced by 38.2% retracement of the latest upleg from 91.09 to 93.87, as well as 55 days exponential moving average that now moves sideways on the 4-hour chart. Current bounce is seen corrective so far, as long as we are holding below 93.50 level. This is approximately here, and this also marks around 50% 61.8% retracement of the latest down leg from 93.87 to 92.73. Break of this barrier is seen as a break point for a possible fresh attack at the upside, as the overall I do apologize. Overall uptrend is still in play despite upside rejection at 93.87 and on approach to next target and psychological barrier at 94.00. And if we see the currently, if we see the basing attempt, and that will be confirmed by break of 93.50, then more focus is seen again towards the upper boundaries 93.87 and 94.00. Otherwise, pardon, break below 92.80 is to open way for further easing. 4-hour indicators are breaking below their midlines. That could be a signal for some stronger action, but again we need to see clear break below 92.70.80 in order to confirm. Immediate target on the downside is 50% retracement at 92.50, 61.8% retracement 92.15, and then we have 92.00 as a round figure and psychological support. On the upside, we already mentioned the 93.45.50 zone is seen as the break point to shift focus again towards 93.87, possible stretch towards 94.00, and then 94.30, where is 200 days moving average. Crude oil, as we mentioned in introduction, is back to strength. Fresh rally from yesterday's low at 95.46, posted a new high at 96.87, keeping the bullish structure now more back, bringing bulls back in play for extension of the broader uptrend from 85.20 higher low, or from the base at 84.05 low of 7th of November 2012, with bulls being now fully in play despite overbought conditions on the 1-hour chart, with our next target being tested so far 96.79, which is 76.4% Fibonacci retracement of larger 172 to 84.05 descent, with the focus, as we mentioned earlier, now coming towards psychological $100 level that could be seen in the coming sessions. From the downside, immediate support and good support is at 95.36. These are the lows of 18th and 22nd of January 2012, and holding above these levels, any reversal lower should ideally find a good support here in order to resume the current bulls, though the further stretch lower wouldn't be that harmful for the oil price. 95.00 is previous highs seen as the next, and the 94.24, 38.2% retracement. Basically anything above 94 is still seen keeping the bulls in play, but seeing the previous reversals, we should expect a dip not lower than 95.00 in order to maintain immediate bullish structure and open extension, open way for extension towards upside targets. 90, we mentioned it, I think 97.81 is the 61.8% retracement of the larger 110.53 to 84, pardon, 77.27 descent, and that should be basically our next upside target ahead of 100 and 172 levels that are seen in the short term as targets. And finally, the yellow metal, we said that it's well supported. It remains basically well supported with 1684 initial support still holding the downside, but still lacking momentum for any push through 1700 as a psychological and a strong barrier. That basically break of which is required to resume the recent rally and open way towards our next target, which is 1706, Fibonacci 100% expansion of the uplift wave, basically third wave from 1653. This wave could extend through to this target in case of a break above 1700. From the other side, warning is seen on further congestion at below 1700 level. That might signal that the wave is, the current wave is running out of steam, and could be a signal for stronger recovery. This current, I would say, rather sideways movement seen under 1700, seeing the downside support at 1684.86. This is the Fibonacci 61.8% expansion, previous resistance now acting as support, and the previous lows at 1684. A break below these levels could be risky for the near-term price action, as this would risk further reversal, while break above 1700 is set to open 1706, and then further up we have 1722, which is 76.4% Fibonacci retracement of the larger 1751 to 1625 descent. And that will be all from me for today's session. If you have any questions, you can type and submit them to me now. Okay, we have one for euro yen. I would say the similar situation to dollar yen, as the pair is descending off its recent high at 120.70, retracing well over 76.4% of the up leg from 116.45, 16th of January low, keeping the downside now in focus in the near term, as hourly studies are negative, as well as 4-hour ones, with the bearish divergence that signaled the reversal now coming fully in play. We are looking for test of 116.45. This is our next downside target, as 4-hour indicators broke in the negative territory, and see more potential towards the downside, especially that 55 days exponential moving average currently at around 117.91 caps the upside, and descending 20 days one is looking for a bearish break below 55 days one that will confirm the negative structure. Basically break below 116.45 and close to it 61.8% retracement of the larger up move from 113.53 to 120.70 is to confirm the reversal and the open way for stronger corrective action of the quite strong rally from let's see it this way, I would say from 100.31. This is the low of 13th of November, where the pair significantly gained to 120.70, and then break below these levels will open previous high and 23.6% retracement at 115.89. As this notion is also supported by reversing hourly indicators that are coming out of the overbought territory, and see more pressure towards the downside, as our initial target comes at and breakpoint comes at 116.45, break of which is to confirm the near-term top at 120.70 and open way for a stronger retracement. We have 76.4% at 115.22. Before this is the previous high at 115.97. So we are looking for a 116.00 and 115.22 as next technical targets in case of loss of 116.45 low of 16th of January. Conversely, any bounce higher sees good resistance at 118.31. Before this, around 118, we have the descending 20 days exponential moving average, and then 55 days one at 118.53. I would say at this point only break above 119 would provide a near-term relief and avert immediate downside risk, but to shift focus completely higher, we need to see break above approximately 119, 120 basically levels in order to refocus 120.70 recent high and the signal possible resumption of the short-term uptrend of euro-yen. Currently we are in the corrective mode, but break below 116.45 as we said is required to accelerate reversal and open way for some stronger retracement of the recent strong rally and upleg from 100.31 to 120.70. Any other question, please? It seems we have no questions for today's session. Thanks to all for attending our sessions. Back tomorrow again at the same time at 8 o'clock GMT. Until then, I wish you a nice Wednesday, good trading, and of course profitable trading. You have to follow the strategies and the rules, and you have already 50% opportunity to make some good profits. Wish you a nice day, and until tomorrow, good luck.